Hey, I'm Mike Priest, the founder and CEO of Visible. As you scale your company, having the right guides at your side can make all of the difference. Each episode, we'll talk to fellow founders, investors, and experts. We'll dive into their zone of genius, as well as hear about their past mistakes to give you a better chance of success. This podcast is for founders by founders. This is The Founders Forward.
Welcome to season 2 of The Founders Forward. For those of you that don't know, season 2 is going to be all about understanding the venture investor psyche. We believe that the best chance of success for companies fundraising is to understand the mindset of the investors. So this season, we're going to talk to investors across the stage spectrum, ranging from investors investing in more lifestyle companies to private equity and everything in between. So today is episode 1. I'm joined by Kenn, who's an associate at Shasta Ventures. Before Shasta, Kenn received his MBA from Kellogg. Also had stints at Hustle Fund, Boston Consulting Group, and a couple other gigs. Kenn, welcome to the show. Did I miss anything there?
No, I think you got most of it. Thanks for having me.
Yeah, awesome. All right, so first thing, Eat Fresh Hong Kong, famous street food. That is your mom's restaurant in the Philippines. You were born there. I checked out the Facebook page. It looks pretty incredible.
I'm surprised you found out about that. But yes. So I grew up in I would say, a very food-oriented family. And kind of one of the ways my mom tried to make a living is because she cooks for us a lot. And actually, a lot of friends ask her to cook for them. She just decided to start up a restaurant. So I grew up inside a restaurant pretty much. Did
you have every job imaginable there, or were you strictly consumer?
I would say 95%, actually 98% consumer.
Okay.
The times when I would help out would be selling stuff on the streets, actually outside the store.
Oh, awesome. Okay. So you're born in the Philippines. I would love just to hear a little bit about your story, right? How is certainly interesting. I think how people get into venture is always interesting, but why too? Why did you get into venture?
Yeah. Let's see. Broad strokes will be that I think when it comes to my career out of undergrad, I've always wanted a job where I can look at what's the latest, look at different stuff, businesses and projects. And that's why I've kind of navigated my way into consulting and investment banking and tried out those stuff. But what I've always found missing was that personal relationship. I think in investment banking and consulting, it tends to be more transactional, really. You go into project 6 weeks and then you're done, and then you probably don't build friendships. And that's really what I missed. And I didn't realize that's the part I was missing until I bumped into venture. So going back to me growing up in the Philippines, I really don't know what venture was until I came to the US and do my MBA. And luckily found my ways into venture and said, wow, this is, I think, the job for me, because it has everything I wanted in looking at different businesses and meeting different people. But there's really more of a personal relationship building there.
Yeah. Do you remember what the catalyst was? So you're getting your MBA at Kellogg. Was there something you read, a class you took, or what was your intro into venture?
Yeah, it was. I would say the real catalyst was a program in Kellogg wherein we would be sent to San Francisco to do 1 quarter there.
Okay.
And then part of the program was you had to intern with either a startup in the VC. And I decided to intern with the VC. Luckily, was able to convince one of the partners at Shasta to take me as an intern, and then just fell in love with it. And very, very lucky to be offered to join them post graduation as well.
Yeah. Okay. That's awesome. I think that's a good segue. Just to I know Shasta is a brand name, big fun, but maybe for those that don't know, and then I apologize because I know you probably say this every day on an intro call with the founder, but can you just give us general name, rank, serial number type stuff, Shasta, stage, sector, check size, some of that stuff that founders care about?
Yeah, happy to. So Shasta Ventures, been in the Valley 16, 17 years. And I would say maybe starting off with the history, we used to be a generalist early stage fund, meaning we invested in consumer hardware, business software, and so on. But in 2019, there was the refocusing on just B2B software. So right now, Shasta and the tagline is an early stage investor in B2B software or enterprise software. Early stage differs from fund to fund, but for us, it's Series A, but we invest anywhere from C to Series B. Check sizes has been interesting. I think we'll be talking about this later as how the VC world has changed is that we've been very flexible now. I would say our average check size is 5 to 10, but I think right now is that we're being more flexible as long as we have conviction in the founders and the company.
Flexible as in smaller, or flexible as in larger, or both?
Both.
Okay.
Tends to be smaller, I would say, just from our experience.
Yeah. Okay. Awesome. Yeah, we're certainly going to cover that. I think, one of the things that I find fascinating is you wrote a book. So you wrote this book about venture at the junior level. Why did you write this book? Like, there's a ton of things. Like, was this something that you wanted to, based on your own experience, or like why write a book about breaking into venture, at the junior level?
Yeah. Two reasons. One is self-serving. Second is pay it forward. First is self-serving is because I get asked the same questions. So it's just an easy resource. It's like FAQs. This is what I did, and this is how you do it, and so on. But also pay it forward. A lot of people help me to get into where I am. So I think this is a way for me to do the same for those who are really interested in becoming a junior VC.
So junior VC is pretty interesting, right? If you go on tech Twitter, quote unquote tech Twitter, and you read kind of two different takes. You read takes of like, talking to an associate is like not the best use of the time for a founder. Like, you should ignore those, and you should only fundraise when you're fundraising, right? Run a tight cycle, etc. Then there's the other kind of take, which is you should always be fundraising. Associates can be like great champions for you. You should really leverage people at the fund that are maybe not partners. And so I know your answer is going to be biased, but like, how can founders leverage maybe non-partners at a fund, associates, principals, maybe operating partners when they're fundraising? Like, how should I think about spending my time with, Kenn? And maybe Kenn reaches out to me outbound. Should I take that call? Why should I take that call? And what are you hoping to, build out of that initial meeting?
Yeah, I think that's a good point. I think there's always a debate, but I think maybe biased, but I genuinely think this, even if, say, I'm a partner, it's good to always build the relationship with the associate if you don't have a good into the partner. Like, I think it just makes sense that you always try to build a relationship with the partner directly. But the thing is that with partners, especially senior ones, they probably sit on 5 to 10 boards. And then whatever time they have left, they give to family, and maybe 10% goes to finding new investments. And when it comes to finding new investments, they have probably, based on their experience, very specific areas they want to focus on. So they just don't have the time really to look at new companies, if you think about it. And associates, their role is to build relationships with founders. And they're kind of different from the fund, but their success metric is actually championing a deal throughout the investment process. And that's why you should really build a relationship with associates, because that's their role, really, to find new companies to build a relationship with. And if they're excited, they'll champion you throughout the whole process.
What percentage of deals do you think Shasta or similar funds, like what percent of those deals are being sourced through an associate versus like an introduction right to a partner? Like, do you have any interesting data on what role, or because you mentioned like one of the success metrics is like sourcing companies, like any idea of like what percentage that might be?
I don't think so. I think there's an interesting survey by Harvard researchers who did like surveyed almost 1,000 VCs. I may be misquoting the number, but I think 30% are around outbound, 30-35%. But it really differs from fund to fund.
Yeah. And how are you spending your day like sourcing companies? Are you don't feel like you have to give away any secret sauce or anything, but like, is it mostly outbound? Is it referrals from other people that you know in your network, or how are you building relationships with founders?
Yeah, I think it's changed from the time I started to now, where I'm a few years in. I think at the start it was just 100% outbound.
Yeah.
And now that I built relationships and to some extent a little brand name, is that I'm getting more referrals. And I would still say, so from 100% right now, I would say around 50-50, 50% outbound, 50% inbound / referrals. Yeah.
Your balance is good. Like the rule of thumb, even like the best account executives at like a SaaS company in the world, like 50% sure are being done by like an inbound BDR type person, but like the best AEs are always doing their own prospecting still, no matter what. So like
Oh, interesting. I didn't
that
know that.
fits like a rule of thumb. Yeah, it's like I think the best AEs are always doing their own prospecting too. So you kind of fit that model at least. I think venture and B2B enterprise sales like fits a very similar kind of funding or like funnel in a way. So I
Yeah.
always like to run some of those comparisons.
Yeah.
But okay. So we talked about valuation and check sizes and things like that, right? Like,
Right.
I think you recently wrote on your blog, and we'll make sure to link to this in the post. A couple examples like Clubhouse, Retool, both raised at over like $1 billion valuation. You know, Clubhouse I think doesn't have any revenue, at least from what I know, and Retool I think it was like 100x, right? I think they're doing $10 million, which is great. I mean, I think it's kind of well known. Like, oh, that might be crazy, maybe not. So like, you know, why is this happening? Like what's going on in the venture space right now where you're seeing larger check sizes and different valuations? Like I know you've written about this, but I'd be just curious to hear so that founders understand, like you read these headlines, but why is this actually happening from a fundamental perspective?
Yeah, I would say two reasons. I think one is supply and demand of capital. Second is just how exit sizes have changes. Like some companies are now just going out being valued at 100 billion at IPO. So I think those are the two main reasons. So kind of digging down into the first one first, supply and demand, right? I think in the article, I mentioned that the number of new companies being created each year has only increased 40%. So let's say the number of companies in 2010, let's say 1,000 were created in that year.
Yeah.
In 2020, it's 1,400, like a 40% increase. But the amount of venture money that went in, the growth from 2010 to 2020 grew 400%. With a 10x difference, right? And you think about just basic supply and demand being the demand for startups and the supply being the amount of capital going to those startups, just like the valuations will just increase, the price increases too. So that's one. And there's a couple more nuances into that we can dig into later. Like there's now more bigger Megafunds, and as the Megafund, you have to deploy larger checks and so on. That kind of influences the dynamic as well. But going to the second one of just like larger exit sizes, kind of stepping back, I think the dynamic in every VC investor and really any investor's head is that what's the potential exit? Right? I invested 100 million. What will it IPO and get acquired at? And the growth at which the valuation at which companies IPO at has grown, I think 7x over the past 10 years. And so that's one reason why investors are willing to make a larger bet, because they expect their investments to exit at the larger valuation.
What? Let's go back to the I guess the former around supply and demand. So 10 years, capital's increased 400%, which is greatly outpacing number of companies being started. Why is there like an influx of, this is a way outside my pay grade, like why is there influx of capital in the venture, right? Is it super macroeconomic reasons, like people looking for yield and they're not getting it somewhere? Because like venture as an asset class is pretty interesting data as well. Like I believe like 25%, you know, to be in a lot of funds don't even return capital back. So like, why are people willing to pour more capital in if the asset class itself is kind of like,
Yeah, that's a really good question. I think one thread going there is that because of the really good venture returns, a lot of the big hedge funds, public market players just went into venture. Classic is Tiger Global, Co2, and so on. So that's one reason. But I think second reason is just how you mentioned this macro is like a lot of the economic development and strength, I guess politically as well, comes from technology companies. And now they have much more outsized returns and larger roles and brand names and so on, lots of different factors. And these are all venture-backed companies. And that's one reason why a lot of these pension funds, institutional LPs say, hey, let's go into venture. Aside from returns, there's also all of these other soft aspects as well.
Yeah. In terms of the mega fund, would you consider Shasta a mega fund?
No. So mega fund in my head is if they raise the fund, so not the whole firm, but the fund of $1 billion or more.
Okay. And so like, what's the risk of a founder, right? Because they need to deploy a lot of capital, right? To return that type of fund. need a lot of returns, right? Bigger check sizes. Like, what's my risk as a founder if I'm looking at one of like the mega like funds leads my, one of my early rounds, right? Because they're investing across pretty much every single stage. Like, what risk do I have as a founder when I look at something like a mega fund?
Yeah. I think there's a couple of aspects there. One is signaling risk, which is very much real, and that you probably read from all around the internet, is that if Sequoia led you around, why are they not doubling down? Like, there must be something, right? Because any rational financial investor would double down in a good investment. And for a lot of VCs, that's a red flag. That's one real risk. And second, which is not so much related, which is kind of indirectly related to megafunds, but more directly related to valuation. So megafunds tend to pay up more, higher valuations, and that is a risk because you have to be able to grow into your valuation. And if you don't achieve that, that's also a risk. And the risk there is primarily around down rounds, and which has a number of other implications.
Yeah. And what about investors, right? Like, what are the risks for investors when you're investing at 100x valuation, where you're paying quite a premium maybe on the company? Like, how do you think about that risk, and maybe what are ways to maybe mitigate risk of such a high valuation in a company?
I think the main risk is that you're just going to lose the money or not have a lot of profits over it. Essentially, financial investors aim to generate profit. And once you're investing at $1 billion, think about what are the potential upsides. Like, what's the likelihood of the company growing to 10 billion? I mean, it might be larger, but by how much larger would that probability be? So the risk really is having a bad fund. And the ways to mitigate that, I think that capture some anecdotes that I heard from a number of other VCs. Number one is that it's a strategic investment. It's good to have, it's a bad way. I think it's a tricky way of investing is that you just want to have the logo of that company in your fund and all the benefits and signaling effects that brings. Number two is that they want to build a relationship with the founders or the team. They just think it's a rock star team. This may not be the company that might succeed. It might succeed, but if not, we know that this founder is great and we have a better chance of backing their next company. Second way, and this is much less common of mitigating, especially in the Valley, financial engineering. They structure liquidation preferences in their favor, stack them 2x, 3x, whatever. That's how they mitigate it. So I would say those are the ways they mitigate it, but I would say I'm not so convinced on the balance.
Yeah, it's pretty interesting. I can't remember where I read this, but someone looked at all of their data, and basically, like, if you looked at the portfolio, like the financial engineering of like preferences and all that, none of that mattered or made the fund successful. Like, the winners were winners, and that's what made the fund successful. It wasn't like any of the financial engineering of preferences and participation or whatever a VC might add in there, which I think is pretty interesting, but makes sense, right? It kind of follows the power law curve. So
exactly.
Which is pretty interesting. I want to switch gears to like what when you're talking to companies, how frequently are you trying to get on someone's radar before maybe they're a good fit for Shasta, right? So you mentioned Series A, but sometimes seed. Like, are you talking to companies when they're just getting started and maybe call it even like a quote unquote pre-seed company, or how early are you looking to get on a radar of a company, and how early should a company get on your radar? Like, when should I start thinking about like reaching out to Kenn and keeping you up to date of what's going on in my company?
I think it really differs from fund to fund. So I'll give you my answer, and I can share anecdotes about how other funds are doing it as well. I think at the seed or right after seed fundraise is a great way for me to start engaging with the company. And primarily, the reason why I avoid engaging at their seed round is that there is a preference at Shasta for post-revenue. Like, it could be seed, Series A, whatever, but post-revenue. And the reason why I try to avoid engaging at the seed stage is that I don't want it to be a distraction for the founders. Like, I'm just there to build a relationship. And I think as a firm and myself as well, I just want to be super respectful to the founders' time. It's always time for us to kind of That's why I don't too much engage at the seed level, but definitely at the post-seed level, when they've gotten the breather from the fundraising round, that's when I think is the best way to start building a relationship. It's long enough from the Series A when I get the chance to know them at a much longer time, rather than say just start engaging at the Series A, wherein the pace at how fast rounds are going now, 1 week or 2 weeks. I don't know if I can get the conviction that, hey, this is a great person to work with. And likewise, like I'm a great investor to work with in 2 weeks.
Yeah, the shotgun stuff of that's pretty wild. In terms of what's happening, because like the whole fit with your investor is so crucial to your success as a company. We did some data where like the MPS score, we asked founders if you give an MPS score to the investor who made your most recent round, what would it be? And I think like across the survey it was like a 23, which is pretty dismal. Like that's like an airline. And so the whole thing was like it's easier to change your airline than it is to change your VC. So like it's I think it's incredibly important to build relationships with people, because it's a multi-year relationship that you're going to build. So like how should founders think about keeping you up to date of what's going on in their company? This is a little self-serving for Visible, but like, do you like to be on investor updates and hearing what's going on with companies, and what are you looking for, maybe metrics wise, from those companies as they're progressing towards their Series A?
Yeah. Actually, the investor newsletter, investor updates, I think is one of the best tactics to use. I think it's just a very scalable way for both founders and VCs to get updated. Because I think the usual cadence pre all of these newsletter things, which actually I think is not done enough, is that they'll catch up every quarter, try to schedule something 30 minutes. But actually all of the information that usually the VCs want to get can be contained in an email.
Yep.
So I think that's a really great way. So that's one. And I think I missed your other question.
No, I think like I was just curious of how frequently or mediums. You said email. Like what are things that you guys care about? Is it recurring revenue? You mentioned B2B. SaaS companies. Is it like recurring revenue, or there's certain milestones or growth rates you guys like to see? Certain markets, like what gets you excited as your role at Shasta when you're getting those updates from companies?
Yeah, I think the magic number has always been around 1 million ARR. It's a recurring revenue, subscription revenue, focused on. I think in my case, I look at two broad areas. Actually, one broad area, one specific area, and the specific area is around machine learning tooling. So that's where I spend a lot of time on, because I was past data scientist. And then the broad area tends to be around work applications. So think about sales tech, HR tech, legal tech, and so on. That's where I spend a lot of time on. So marketing myself is just if there's any founders out there building startups in those space and have high growth rates. I think the usual benchmark is 2-3x. That is above 1 million ARR. I think that's really the sweet spot for Shasta and myself.
Yeah, awesome. Some questions we're going to ask all guests this season, so we can kind of build a library of responses and have some good resources. Founders reaching out to you cold, like what catches your eye? What are you most likely to engage with if a founder's emailing you cold?
Yeah, I think hard data points. I think being on the Series A investor, there should be enough data about revenue or user traction. I think that's one, how much they've grown in the current revenue. Second is just a sprinkling of the customers, the logos they've won, because I think that signals a lot. For example, a SaaS company sells to Salesforce. That's probably went through a battery of tests and validation. So that's a really good signal. And three, and this is less common, but probably why they're winning those logos versus other competitors. Right? Because eventually that's the thing that investors will drill down into. Because right now it's so competitive in the SaaS space, there's probably 20, 30 companies doing the same thing. But if you can highlight why you're winning, you're better, and there's proof point of winning a customer, I think that would just catch my eye.
Yeah. And related to that, what's the number one thing founders can do to help create momentum in their fundraising process?
I think this is one effective way, is just say, this is a tongue-in-cheek answer. It's just say, oh, Sequoia is looking at us. A lot of other VCs, syndicate funds, solo capitalists will start looking at it as well. I think that's one tongue-in-cheek answer. But I think the one more applicable way is something we talked about earlier. It's just keeping the investors updated. And that would include not only metrics, but also saying like, hey, we're gearing up. And I think you pair that with really good data points. And that's how you create really good momentum, organic momentum, instead of maybe something less organic, name dropping tier one VCs looking into you.
Yeah. If someone thinks they're a good fit for Shasta, outside of contacting you, like any good tips for getting in touch? Like, what's the best? Is it getting an intro, or what's the best? I guess success for getting a meeting at least with Shasta, and then would love just to kind of hear your guys' process as well. Like, is there a partner meeting, and it's like you need to have a majority for like once we fast forward now through diligence and we're talking about a term sheet, like how are those decisions made as well?
Yeah, so I think on the first way, the easiest way is getting a warm intro, especially from founders and investors that we worked with before. I think that's the fastest way. But bar that, I think even though a lot has been said about VC being quite a close network, I think most VCs still entertain cold emails a lot. I think cold email still works. So email me. I think most VCs emails are out there anyway. So it's very easy to find. So the process differs by the check size. So let's just bucket into small check and large checks.
Okay.
Small checks, relatively straightforward process. Depends on who your first contact is. Assuming I'm the first contact, I really like it. I'll loop in some partners. I think the approval process is really support from 2 partners, and then that's it. So there's no need for the whole partnership to meet and decide. So that's a small check process. A larger check process would then be contact me. I'll loop in the right colleagues and whether that's venture partners or actually investment partners to do due diligence with. And then process takes around 2-3 weeks, or depending on how the round goes. Right now, that's even long considering the pace of VC right now. And then it culminates in a partners meeting. And then there's a decision within that week, whether a term sheet or no.
The pace, let's go back to the pace right now, because that keeps coming up. Pace and check size, like you got new people like Tiger Global, maybe not new, but they're clearly making a lot of headlines. What is going on that's causing not only, I guess, is it just supply and demand? Is it that imbalance that you mentioned of there's like a lot of capital, and so founders want to move fast, and that's what's creating this environment of not only higher or bigger check sizes, but also faster rounds getting done?
I think there's two things to tease out there. I think one is really, like you said, the supply, which means it's much more competitive. And for founders who actually just want to keep on building, speed is very important to them. I think the second aspect is, since we keep on talking about Tiger Global, is that they're, even though they have a very small official full-time investment team, they actually kind of outsource all of the associate work to Bain, or one of the consulting companies. So they have like hundreds of consultants on staff that's actually doing the work for them, so they can actually move at speed. So that's the other dynamic.
Interesting. Yeah, awesome. What's next for you, Kenn? Are you looking to be a lifelong venture investor, or are there other things at some point you want to go do? I know some people do shorter, maybe not shorter stints, but stints at venture funds. Like, what are you looking to do long term, and what gets you excited and have energy every day?
Yeah, I think the current direction is being a lifelong investor. I think I really enjoy this job. Very lucky to have landed into it. I just really enjoy. I think like most people who are in the job, enjoy meeting new people, smart people trying to do something, usually something for the betterment of the world, if I want to sound very, very nice. But I think for most VCs, there's always the option and an itch to build something. You see so many great companies being built, you just kind of want to be part of it. So I always have that option in the back of my head. Whenever there's something I see that, hey, I just really want to build, but nothing yet so far. So right now, life of an investor.
Love it. Well, Ken, can't thank you enough for joining and sharing your story with us and walking us through, your day-to-day role and how founders can be better at hopefully running a fundraising process. Again, really appreciate the time. Everyone else, we'll catch you on episode 2 of season 2 coming out soon. And we'll see everyone shortly. Thanks.